We now come to the world of non-mortgage asset-backed securities. These are generally simply referred to as ABS or asset-backed securities. Asset-backed securities are backed by a wide range of asset types. The most popular non-mortgage asset-backed securities are auto loan receivable-backed securities and credit card receivable-backed securities. With auto loan receivable-backed securities, the collateral is amortizing, and this is similar to what we have seen with mortgage-backed securities. However, for credit card receivable-backed securities, the collateral is non-amortizing, and we'll talk about this in detail when we discuss credit card receivable-backed securities. Keep in mind that asset-backed securities must offer credit enhancement to be appealing to investors. The reason is that there is credit risk or default risk associated with the underlying pool, and in order to keep investors happy, there needs to be some form of credit enhancement. Here is a simplified version of auto loan receivable-backed securities. What you are seeing here is a pool of auto loans, and the asset-backed securities are based on or backed by these auto loans. Here are the people who have taken out the auto loans. So this is John. He has borrowed money to buy this particular car. The institution that has lent John the money has sold these auto loans to a financial institution. I'm skipping all the securitization details because we have discussed them before. So this is a simple picture. We are simply showing the pool of auto loans and saying that John is going to make payments. This cash flow will consist of interest payments, scheduled principal repayments, and any prepayments. In fact, all other car owners who have taken out loans will be doing the same, and then this cash flow flows through to asset-backed securities. There will be multiple tranches, there will be credit enhancements and so on, but ultimately this cash flow, after a certain service fee and after other expenses are taken out, the cash flow will flow through to the bondholders. Now let's consider prepayments in a little more detail. So what is it that drives prepayments? Recall that with mortgage-backed securities, a big factor that resulted in prepayments was changes in interest rates. We said that when interest rates go down, then prepayments go up. With asset-backed securities, especially asset-backed securities which are backed by auto loan receivables, while prepayments are impacted by interest rates, but there are many other factors which drive prepayments. So let's understand that. Prepayments result from sales and trade-ins requiring full payoff of the loan. So let's say John sells this car. If he sells this car, he gets the money, he pays off this loan. That means a fair amount of money flows in. That is a prepayment. If he trades in this car and gets another car, then the loan associated with this particular car needs to be paid off. So that results in a prepayment. Repossessions and subsequent resale of vehicles. Let's say this is Jim, and for some reason Jim is not making his payments. The servicer can collect or can take this car, sell it, and that results in money flowing in. That also is a prepayment. Insurance proceeds received upon loss or destruction of vehicle. Payoffs of the loan with cash to save on interest costs. Refinancing of loans at lower interest rates. So notice these are multiple reasons that result in payments being made, and obviously that ultimately results in prepayments for the bondholders. Of all these reasons, only the last few relate to interest rates, and since the cost of a car often is much lower than the cost of a house, the benefit from refinancing isn't that much. So while this does happen, but it is not as common as refinancing for home mortgages. So prepayments are somewhat interest rate sensitive, but not as interest rate sensitive as mortgage loans. All auto loan backed securities have some form of credit enhancement. We could have a senior subordinated structure, so the senior tranches have credit enhancement. We've talked about this multiple times. Other strategies are reserve account, over collateralization, and excess interest on the receivables. The reserve account simply refers to extra funds which are deposited so as to protect the bondholders. We've talked about over collateralization before. If the total collateral is worth 950 million and bonds issued have a par value of 900 million, then that extra 50 million is the over collateralization. This helps protect the bondholders. Excess interest on the receivables. Let's say that the interest rate on the auto loans is 9% and the service cost is approximately 1%. That leaves us with 8%, but on average the rate paid to bondholders is 7%. The difference here is the excess interest. It is also called the excess spread. We now come to credit card receivable backed securities. Here, credit card receivables are used as collateral for the issuance of credit card receivable backed securities. A simple version is illustrated here. These represent a pool or the pool of credit card receivables, and it is against this pool that the asset-backed securities are issued. As I did with the auto loan example, I just want to illustrate what's going on. So this is Paul. He gets a Visa card from his bank, and obviously he then needs to make payments. Now, what are the payments that he makes? Obviously, this is Paul. He gets a Visa card and uses this card to buy goods and services. So what are the payments that Paul makes? The payments he makes consists of finance charges. So if he runs a balance and needs to pay interest, that's finance charges. He might have to pay fees. There might be principal repayments. So if he buys something for $100 and has to pay interest, he could be paying interest, other charges, and then at times he will pay back the principal. So all these payments are made by John. They flow in, and those are the payments that ultimately flow through to the bondholders. Finance charges collected represent the periodic interest the card borrower is charged on the unpaid balance after the grace period. Anyone who owns a credit card knows that there is a certain grace period during which the principal can be repaid without any finance charges, but if the principal is not paid by that date, then there will be an interest charge. In the credit card world, that interest charge is generally called the finance charge. If charges are not paid on time, then there would be a late fee. So that could also be part of the cash flows. There might be annual membership fees, and that also would be part of the cash flows. Interest is paid to security holders periodically. This could be monthly, quarterly, or semi-annually. The interest rate may be fixed or floating. Credit card receivable backed securities are non-amortizing loans, and this is an important term. A non-amortizing loan is one where there isn't a schedule for paying down the principal, and that's what happens with credit card loans. Say a credit card holder uses $100 to buy something, and as long as that credit card holder is paying the interest on top of this amount, there is no scheduled date by which he has to pay off that $100. So that's why we say that this is a non-amortizing loan. They have lockout periods during which the cash flow that is paid out to security holders is based only on finance charges collected and fees. So what does this mean? Let's say that this is a pool of credit card receivables, and let's also say that our lockout period is 1 year. During this 1 year period, obviously there will be interest payments, but there will also be some principal payments. So some credit card holders are going to pay off the principal. That principal, however, is not going to flow through to the bondholders. Only the interest that comes from these credit card receivables will go through to the bondholders. The principal is used to issue new loans. Because of this, the number of credit card receivables might actually increase during the lockout period. For example, initially there might have been 50 loans in this pool, and it is possible that with this principal being used to issue new loans, this number increases from 50 to 60. Once the lockout period is over, then the principal payments will flow through to the bondholders, and that's where these loans retire, and ultimately the asset-backed securities will also mature. Certain provisions in credit card receivable-backed securities require early amortization of the principal if certain events occur. Such provisions are referred to as early amortization or rapid amortization provisions and are included to safeguard the credit quality of the issue. The only way the principal cash flows can be altered is by triggering the early amortization provision. The curriculum doesn't give much detail here, but the point is relatively straightforward. If there is a fear that there will be an increase in defaults, then a safe strategy would be to start making principal payments to the bondholders. So rather than issuing new loans, new credit card loans, it would make sense to collect the principal that existing cardholders are sending in and use that principal to pay off the asset-backed securities. Before we move to the next slide, I want you to think about the two major differences between asset-backed securities which are backed by auto loans and asset-backed securities which are backed by credit card loans. And this is based on an example in the curriculum. It's example 12. The first major difference is that the collateral for credit card loan based securities is non-amortizing. So the loans are non-amortizing, whereas for auto loans, the loan is amortizing. The second major difference is that with credit card loans, we have this lockout period, and during the lockout period, any principal payments that come in from credit card holders are used to issue new loans. This does not happen with auto loan backed asset-backed securities. We now come to the final section in this long reading, which is collateralized debt obligations. A collateralized debt obligation, or CDO, is a generic term used to describe a security backed by a diversified pool of one or more debt obligations. That is illustrated over here. This is the pool of debt obligations, and the debt obligations could include corporate bonds, emerging market bonds, leveraged bank bonds, asset-backed securities, various kinds of mortgage-backed securities, and even other CDOs. Like an asset-backed security, a CDO involves the creation of an SPV. So it is the SPV which will hold these various assets or debt obligations. But in contrast to an ABS, where funds necessary to pay the bond classes come from a pool of loans that must be serviced, a CDO requires a collateral manager to buy and sell debt obligations to and from the CDO's portfolio of assets to generate sufficient cash flows to meet the obligations of the CDO bondholders and to generate a fair return for the equity holders. This illustrates the important difference between a CDO and an asset-backed security. So you need to recognize that asset-backed securities are different from CDOs. With asset-backed securities, the cash flow associated with the securitized assets is what is used to pay off the bonds or the asset-backed securities. With a CDO, the SPV owns this pool of assets, and there is a collateral manager who actually is buying and selling these assets. So for example, if a corporate bond is underpriced, the CDO manager will buy it, and if a particular bond is overpriced, then the CDO manager will sell that bond. So money is being made both through capital gains, in other words, buying and selling of these debt-based assets, and also since the collateral manager is sitting on these assets, there is cash flow associated with the assets. So it's the combination of income and capital gains which is being used to pay off the CDOs. Also note that there are different levels or different classes over here. We will have senior CDOs, a mezzanine layer, and then equity tranches. The equity tranches would get a return after the senior and the mezzanine tranches are paid off. Let us now consider a simple CDO example. Say that our collateral consists of 100 million worth of corporate bonds which pay a fixed rate of 11%. This is a simplified version. Obviously, in the real world, the collateral will have lots of different kinds of instruments, but here we are simply saying that effectively we are getting an 11% fixed rate. Now, for this particular CDO, we have three tranches: the senior, the mezzanine, and the subordinated or the equity tranche. The commitment to the senior tranche is that we need to pay LIBOR plus 70 basis points. The mezzanine tranche, we need to make a fixed payment of 9%, and we need to figure out how much the subordinated or the equity tranche will get. Let us assume here that the fee for the collateral manager is 0.64 million. So 11% of 100 million, this is the cash flow coming from the collateral. 11% of 100 million is 11 million. Another important point is that the senior tranche is getting LIBOR plus 70 basis points. So this is a floating rate, but the collateral is paying a fixed rate. So what the CDO manager needs to do is he needs to enter into a swap where he pays fixed and receives a floating rate. This swap is available where the notional principal is 80 million. This has to match with the notional principal associated with the senior tranche, and in this swap the fixed rate is 8% and the manager receives LIBOR, which means that the fixed payment will be 80 million into 8%. That is 6.4 million. That's the fixed payment, and the amount that the manager receives is LIBOR. So overall, what does the manager get? The manager gets LIBOR and 4.6 million. Where is this 4.6 million coming from? Recall that the total amount from the collateral is 11 million. Of that, 6.4 is being paid for the swap, and what is left is 4.6 million. So effectively the manager is getting LIBOR and 4.6 million. The manager's fee, the collateral manager's fee, is 0.64 million. What are the fees that need to be paid, or what is the amount that needs to be paid to the senior tranche? That is LIBOR and 70 basis points. LIBOR is being received from here, LIBOR needs to be paid, so this cancels out. There is still 70 basis points. 70 basis points means 0.7%. 0.7% of 80 million is 0.56 million. The mezzanine tranche needs to get 9% of 10 million. That is 0.9 million. So the total payments are 0.9 million plus 0.56 million plus the fee for the collateral manager, which is 0.64 million. What is the receipt? The receipt is 4.6 million. So if we do 4.6 million minus these three items, 0.64 plus 0.56 plus 0.9, what we get is 2.5 million. And assuming there are no defaults here with the collateral, the return for the subordinated or the equity tranche is 2.5 million out of 100 million. So this is a 25% return. Next, we look at the risks and motivations associated with CDOs. In the case of defaults in the collateral, there is a risk that the manager will fail to earn a return sufficient to pay off the investors in the senior and mezzanine tranches. So in the example that we just saw, we had an 11% return on the collateral, and a fair amount of money was being made because we assumed that there are no defaults. Obviously, if there are several defaults, then the first tranche to suffer would be the equity tranche. And if losses are large, then even the mezzanine and senior tranches might not be able to get the required return. So that is the major risk that we need to be aware of. Motivations for creating a CDO. This is best understood through example 13, and a lot of what you will see here has been discussed before, but from an exam perspective and a testability perspective, this is important, so I will read this out for you. As with an ABS, the creation of an arbitrage CDO involves the creation of an SPV and the pooling of debt obligations. The purpose and management of an arbitrage CDO, however, are different from those of an ABS. With an ABS, the cash flow from the collateral are used to pay off the holders of the bond classes without the active management of the collateral. That is, without a manager altering the composition of the debt obligations in the pool that is backing the securitization. In contrast, in an arbitrage CDO, a CDO manager buys and sells debt obligations with the dual purpose of not only paying off the holders of the bond classes, but also generating an attractive or competitive return for the subordinated equity tranche and for the manager. From CDOs, we move to covered bonds. Covered bonds are senior debt obligations issued by a financial institution and backed by a segregated pool of assets that typically consist of commercial or residential mortgages or public sector assets. So in this sense, covered bonds also seem to be very similar to asset-backed securities, but there are some differences. One difference is that covered bonds have a dual recourse nature. This means that investors have claims against both the issuing financial institution and the underlying asset pool. With respect to regular asset-backed securities, investors only have a claim against the underlying asset pool, and that happens because of the SPV structure. The next point has to do with balance sheet impact. The underlying asset pool remains on the issuing financial institution's balance sheet. It is not transferred to a separate SPV. The covered pool bondholders retain a top priority claim against the pool. So unlike what we've talked before, where we have a financial institution and then a separate SPV is created, in the case of covered bonds, the financial institution directly issues these bonds. It does not create a separate SPV. And hence, the assets that are backing the covered bonds are on the balance sheet of the financial institution. The next point is dynamic cover pool. This means that the underlying pool is not static. The issuing financial institution must replace any prepaid or non-performing assets in the cover pool to ensure sufficient cash flows until maturity. In contrast, asset-backed securities pass through default and prepayment risk to investors. The final difference has to do with redemption regimes in the event of sponsor default. In the event of sponsor default, redemption regimes align the covered bonds' cash flows as closely as possible to the original maturity schedule. And again, this benefits the investors, those who have invested in covered bonds. Because of these additional safety features, covered bonds have lower credit risk compared to asset-backed securities, and lower credit risk also then means that they offer lower yields compared to otherwise similar asset-backed securities. We've come to the end of this very long reading. A quick summary now. You need to understand the securitization process, the fact that we need to create an SPV, which is a separate legal entity, and the pool of assets over here are referred to as securitized assets. The asset-backed securities or mortgage-backed securities are backed by these securitized assets. The big benefit of securitization is that it reduces the cost of funding. Also, the securities that are created can meet the needs of different investors. With residential mortgage-backed securities, we can have agency bonds and non-agency bonds. Agency bonds are guaranteed either implicitly or explicitly by the government. Non-agency bonds do not have the backing of the government. Commercial mortgage-backed securities are backed by commercial income-producing properties. CMOs have mortgage pass-through securities as their collateral. There are several types of non-mortgage asset-backed securities, and here we talked about credit card loans backed asset-backed securities where the collateral is non-amortizing, and we also talked about auto loan backed asset-backed securities. Finally, we talked about collateralized debt obligations which do not fall under the ABS category. The major difference here is that the CDO manager can actually buy and sell the securities that form the collateral in order to generate a positive return. As always, I want you to read the summary, go over the learning objectives, make sure you can say something sensible about each learning objective. I've covered most of the examples. If you have time, try to read them on your own. Also, work through the practice problems. These are extremely important, and also work through other practice questions, the IFT questions, and any other questions you can find.